The announcement lands in early August 2026, like a routine piece of market furniture. TotalEnergies agrees to buy Shell's European onshore renewables business. On the same day, it sells a 50% stake in a portfolio of developed assets to KKR. The headlines treat the move as a sign of the times. Private equity wants power. Oil majors want partners. Green projects need balance sheets that can wait. Then the camera pulls back. KKR has done this kind of thing before. Not with a slice of European wind and solar, with an entire Texas utility. In 2007, a consortium the firm helped lead paid $45 billion for TXU Corp, then the largest leveraged buyout ever completed. Bankers toasted it. Politicians argued over it. For a few months, it looked like proof that financial engineering could swallow the physical world and still leave the lights on. 7 years later, the holding company that replaced TXU walks into bankruptcy court. The filing is not a blackout. It is a confession that the capital structure can no longer stand the weather in a commodity market. In living rooms, the monthly bill still arrives. Dallas still has power. Houston still has power.
The plants still burn and split atoms and spin turbines. Nothing cinematic explodes. No city goes dark. The failure is almost insultingly quiet. Paper dies. Claims die. A thesis about the future price of a fuel dies. That is the contradiction this story exists to open. How do you buy the machinery of ordinary life at a record price, load it with borrowed money, and lose the bet so completely that the owners are wiped out, while the product itself never stops flowing? The answer is not a conspiracy to wreck Texas. The answer is a mechanism, a price, a fuel, a market design that let natural gas set the value of every megawatt, including the ones that never burned gas at all. Wall Street is circling energy again. The objects have greener names. The leverage still has to be paid.
Before it was a trophy, TXU was a Texas institution with a bland name and a brutal position. Headquartered in Dallas, it generated more electricity than any other company in the state. It sold power to households through a retail arm. It moved electrons across a regulated web of wires. After Texas opened its wholesale market in 2002, those three functions no longer lived under one comfortable monopoly logic. Generation became a merchant business. Retail became a competitive scramble. Only the wires still looked like a traditional utility. The grid those plants served was not the national grid. ERCOT, the Electric Reliability Council of Texas, ran an island. Almost no high-voltage ties to the rest of the country. Almost no ability to import a neighbor's surplus when Texas heat spiked. Inside that island, the price of power was set, hour by hour, by the last unit needed to keep the system in balance. Most hours, that last unit burned natural gas. This is the fact most people never see when they look at a coal plant or a nuclear reactor. The fuel inside the boiler is not always the fuel that sets the check. In a competitive stack, cheap baseload runs first. Gas turbines come on later.
The market price for every accepted megawatt rises to whatever that last gas unit requires. When gas is expensive, a lignite plant in East Texas does not merely cover its own costs. It collects a spread the size of the difference between cheap coal and costly gas. A nuclear unit at Comanche Peak does the same. High gas becomes a private tax that flows beautifully to anyone who does not burn it. In 2005 and 2006, that tax looked permanent. Hurricanes ripped through the Gulf. Storage felt tight. Henry Hub, the benchmark that traders treat as the country's gas pulse, printed numbers that would have seemed fictional a decade earlier. Spikes above $10 per million British thermal units. Brief prints even higher. Power prices in ERCOT followed them up the ladder. TXU stock followed the power prices. Executives read the curve as a signal to build. The company announced a fleet of new coal plants, 11 units in the original vision, that would lock in cheap fuel and harvest the gas set price for decades. Oak Grove, Sandow, names that sounded like towns and functioned like factories. Environmental groups saw a carbon bomb on the Texas prairie.
Wall Street saw a spread that could be modeled, leveraged, and sold. What most viewers miss is how specific the optimism was. It was not a vague faith in energy as an idea, it was a one-variable machine.
If gas stayed scarce, the old coal and nuclear fleet was a printing press. If gas stayed scarce, new coal would be a second printing press. If gas stayed scarce, the political cost of carbon might be bargained down, delayed, or paid for out of the spread. Every slide deck assumed the scarcity. Texas heat made the story feel physical. August afternoons, air conditioners roaring from El Paso to Beaumont, reserves thinning, prices flashing in the wholesale market at levels that made industrial customers swear and generators smile. The island grid turned weather into money. A financial buyer looking at TXU in those years did not see a sleepy municipal service. He saw a set of plants sitting under a meteorological and geological thesis. The geological part was the blind spot. At that moment, the Barnett Shale was already being drilled beneath Fort Worth, not far from the company's own backyard. The techniques were improving. Horizontal wells, slick water fractures, more stages.
More sand. The public debate, though, still ran on the old map. Peak gas, import terminals, LNG tankers, scarcity priced as destiny. The people who would later flood the market with shale molecules were not yet a consensus. They were a rumor in a core sample. So the company that looked most like Texas, big, confident, certain that heat and growth would underwrite any balance sheet, became, in the eyes of New York and San Francisco, a perfect asset. Not because electricity is romantic, because a deregulated island had turned a fuel price into a master key. Whoever owned the key could, in theory, own the cash. That theory would be tested at a scale no utility buyout had ever attempted. Henry Kravis and George Roberts had already taught a generation of bankers that a company was a capital structure wearing an operating costume. David Bonderman and Jim Coulter at TPG had made a specialty of large, political, messy assets. Goldman Sachs sat on both sides of the glass, advisor, lender, and through its principal investing arm, owner. Together, they did not buy a vision of Texas. They bought a path for the price of gas. C. John Wilder, TXU's chief executive, was the man who could open the door. He had already recast the company as a generation machine rather than a sleepy, integrated utility. When the consortium came, the offer was concrete enough to end the argument. $69.25 a share. A premium fat enough to satisfy a board and sharp enough to discourage a rival. Wilder's own exit was measured in the hundreds of millions of dollars. That number is not gossip. It is the human face of a deal in which management is paid to prefer a certain close over an uncertain independence. The buyers put up about $8 billion of equity. Everything else would be borrowed against the company they were about to own. That is the lever. Equity is the amount you can actually lose. Debt is the amount the plants, the customers, and the future cash must service whether the thesis is right or not. In early 2007, credit was still a carnival. Banks would line up for fees. Bond desks would sell the paper. The future looked like a spreadsheet in which gas never learned to fall. They also bought politics. The original coal build-out had become a national target. Fred Krupp at the Environmental Defense Fund and allies at the Natural Resources Defense Council wanted plants canceled, not merely delayed. William Riley, a former administrator of the Environmental Protection Agency, was brought in as a kind of moral translator. 8 of the 11 proposed coal units vanished from the plan. 3 remained. The buyers got a quieter permit war. The environmental groups got a public victory. The remaining coal and nuclear fleet still sat under the same gas set price. The bet did not become greener in its mathematics. It became easier to close. On February 26, 2007, the announcement hit the wires. For a day, the story is scale. Largest leveraged buyout in history. A utility treated like a software company. What the press kit cannot say out loud is the private psychology. Each firm wants the tombstone. Each partner wants the carry. Each lender wants the fee now and the covenant later. No one in that room is paid to imagine a Texas under the Fort Worth suburbs opening like a valve. They are paid to imagine the opposite. Scarcity with a ticker symbol, heat that never stops, a fuel that stays obedient. Ambition here is not cartoon villainy. It is a narrower thing, a belief that the recent past is a law,
a belief that an island grid plus expensive gas plus baseload plants equals a coupon that can bear almost any interest rate. Once that belief is shared by the people who can write the checks, the deal stops being a question and becomes a race to the closing dinner.
The transaction closes on October 10th, 2007. The name on the door changes: Energy Future Holdings. Under it, the old body is carved into pieces with different legal skins. Luminant holds the generation. TXU Energy keeps the retail customers. Encore, the regulated wires business, is ring-fenced so that a failure in the merchant plants cannot simply seize the poles and transformers. That ring fence is not a courtesy. Texas regulators will not hand the physical grid to a pile of buyout debt. The consortium accepts the wall because the prize, in their model, is not the wires. The prize is the spread. Credit markets are already tightening as the ink dries. Within months, the wider financial system begins to seize. That is bad weather for anyone who has just loaded a company with loans and bonds. It is not yet fatal. Fatal arrives from the ground. Drillers in the Barnett keep improving. Then Haynesville. Then the Marcellus, a formation so large it makes the old scarcity maps look like folklore. Horizontal wells, longer laterals, more fracture stages, sand by the trainload. Each increment looks small in a field report. Together, they turn the United States from a would-be importer of liquefied gas into a country drowning in its own molecules. The LNG terminals that were supposed to receive fuel are, within a few years, being talked about as export machines instead. Henry Hub does not politely decline. It falls through the floor the model was standing on. From the double-digit prints of the mid-decade scare to averages that slouch under $4. In 2012, the benchmark spend stretches near 2. Some days it behaves like a leftover, not a treasure. Watch what that does inside ERCOT. The last unit is still often a gas plant, but the last unit is now cheap. The market price for every megawatt comes down with it. The lignite units still run. The nuclear units still run. Their fuel costs have not magically risen. Their revenue has collapsed. The beautiful tax reverses. What had been a spread becomes a squeeze. Luminant is a merchant generator in a low-price island, carrying interest payments designed for a high-price island. And then, everything breaks. Not the turbines, the arithmetic. Cash from operations no longer covers the capital structure with any comfort.
Lawyers begin the long American ritual of an over-levered company that is still, operationally, quite real. First come the out-of-court talks. First lien lenders against second lien lenders. Holders of holding company paper against holders of operating company paper. Each clause in the 2007 documents becomes a weapon. Each projection of a gas recovery becomes a prayer that the other side will blink. There is no recovery of the old kind. Shale is not a hurricane. A hurricane ends. A drilling technique that works in 3 basins does not end because a private equity memo needs it to. On April 29, 2014, Energy Future Holdings files for Chapter 11 protection. The petition carries roughly $40 billion of debt. The $8 billion of sponsor equity is not reorganized into a smaller prize. It is extinguished. KKR, TPG, and Goldman do not lose a rounding error. They lose the check that was supposed to be the smartest infrastructure trade of the decade. This is the wound the press keeps getting slightly wrong. Texas does not lose its electricity supply. Encore keeps moving power under the ring fence. Plants keep dispatching into the same island grid.
Households do not sit in the dark because a holding company in Delaware has run out of story. What dies is the claim that a record buyout can treat merchant generation like a toll road. A toll road has a rate case. A merchant plant has a fuel it does not control, and a price set by whoever else can produce that fuel more cheaply. The case crawls. Years, not months. In 2016, the generation and retail estate begins to emerge under a new public name, Vistra, with creditors sitting where the buyout firms used to sit. The wires company later draws a different kind of buyer, the sort that wants regulated assets rather than a gas thesis. Sempra's later purchase of Encore is a verdict in slow motion.
The part of the old TXU that looked boring was the part that could still be sold as a business rather than as a courtroom. Bondholders take haircuts of different depths depending on where they sat in the stack. Employees keep showing up to plants that never received a memo about financial engineering. The physical system absorbs the failure the way a bridge absorbs a change of owner. It does not care who lost the equity.
What the 2014 filing proves, with the bluntness of a docket number, is that scale is not safety. $45 billion of enterprise value did not make the thesis truer. It only made the error louder. The consortium had not bought a utility in the civic sense. It had bought a leveraged option on one commodity remaining scarce inside one isolated market. When the option expired worthless, the option sellers, the owners, were gone. The grid, indifferent, kept its schedule. Leave the scene in the courtroom, not on a darkened block. Lawyers stacking boxes. A judge administering a corpse that still throws sparks 1,000 miles away. A fuel price printed on a screen in Louisiana, deciding the fate of a Dallas balance sheet. That is the climax. No explosion. A number that refused to stay in the cell where the model put it. A power system can survive a bad owner. It is less clear that a financial structure can survive a living fuel. The TXU years teach a principle that has nothing to do with villainy and everything to do with mismatched clocks. Electricity is an instant. Debt is a calendar. Geology is a decade that does not attend your closing dinner. When those three clocks are forced into one capital structure, the structure will eventually tell the truth. In this case, the truth was simple. Merchant cash flows set by a commodity you do not control cannot carry a buyout sized for permanence. That is why the new money circling energy tries to look different, even when some of the letterheads are the same. Contracted renewables sell a price that has already been signed. Regulated wires sell a return that a commission can argue about but not forget. Those assets can still be overpaid for. They can still be stuffed with fees. They are not the same instrument as a fleet of plants whose every megawatt is priced by the last gas turbine on an isolated afternoon. Confusing the two is how a record deal becomes a case study. The human stakes sit in the gap between service and claim.
Families in Fort Worth never needed the sponsors to be right. They needed voltage. Workers at a lignite plant never needed the carry formula. They needed a shift schedule. The bankruptcy took care of the people who had purchased a story about scarcity. It left the people who purchased kilowatt hours almost untouched, except insofar as a weakened generator changes how a weakened generator changes how a market invests for the next heat wave. That quieter second-order effect is where a failure of paper can still reach a living city. Not as darkness on the filing day, as a thinner incentive to build the next unit, or a sharper fight over who must hold backup capacity when the weather turns. Private equity will keep arriving at the meter. The returns are advertised as infrastructure, as ballast, as the opposite of speculation. Sometimes that is accurate. Sometimes it is a costume placed on the same old lever. A small equity check, a large stack of obligations, and a hope that the physical world will remain as well behaved as the model. Picture a control room in Texas on a still night, screens full of load, a dispatcher who has never met a partner in New York.
Somewhere else, a term sheet for another energy stake, cleaner in its branding, just as sure of its math. The plants hum. The debt, wherever it now lives, waits for a price. If the next essential system is bought with money that only works when one number stays obedient, who exactly is supposed to notice before the filing?